All right, everyone, welcome back. Thank you as always for listening and watching this week. This week we have another retirement planner chat, always a fun one. Today I'm joined by Allen Mueller from 7 Saturdays Financial. What's up, Allen?
Hey, how's it going?
It is going swimmingly well, sorry. How about you?
Oh, can't complain.
Yeah. And if you did, no one will listen?
What's that?
And if you did, no one will listen?
Yeah, pretty much.
Yeah. I used to work, my first job on the books was at a supermarket when I was sophomore in high school, and I was a cashier, and I worked Sunday mornings because that was like the busy shift, and some other days throughout the week, but Sunday mornings always. And it was a town with a lot of folks who were kind of older, and there was these people who had their same routines and jokes every single time. And one woman, she'd ask me invariably every single time, how's it going? I'd say like, well, or whatever. She'd say, working hard or hardly working. And every time I chuckled. And then she'd also say, I'd ask, how's it going? And she's like, can't complain. She said, even if I did, no one will listen anyway. So that,
you gotta love those zingers.
Yeah, they're good. And also, important sort of formative moment for me working at that supermarket, just for the fun of it, in case anyone's interested. I learned, well, not learned, but I sort of observed that a lot of people are 70 plus, kind of fall into one or two categories. There's people who are always sort of crotchety, cranky, complaining about the line was too long, or, this thing rang up 2 cents too much, or whatever. The coupon was expired and they didn't realize it. And just always something to be complaining and sour about. And there's other people, like, no care in the world. They were just happy to be out and about. Didn't matter if the line was, 20 minutes long or whatever. And I was like, you know what? I don't know what life's all about, but I want to be like that when I get older, because they seem happy. That's my goal. So
life goals for sure.
Exactly. All right. Sorry for all that sidebar, but did you know what's the part of the body that's the last to stop working? Any idea?
Should know this because I'm expert at dad jokes, but I'll just say I don't know. The legs?
No, it's your pupils because they dilate.
Okay, that's pretty good.
Yeah, it's terrible. So let us get into it. Can you give a quick background about yourself, your bio, your firm, et cetera, and we'll just kind of take it from there.
Yeah. So I'm Allen Mueller, founder of 7 Saturdays Financial. My wife likes to jokingly call it 7 Mondays Financial because I work a bit on the weekends because I love what I do. But my background's a little bit different than most financial planners. So I describe myself as an engineer turned finance nerd. Started out, went to college for engineering, spent a few years in operations, actually in the mining industry. And as professional development, decided to go back and get an MBA business degree. So that was very eye-opening for me. Never had any exposure to economics or finance or accounting. So, really interested in that. I wanted to go in that direction. So I pivoted my career and spent about 10 years in corporate finance. So I think I was getting closer to ultimately what I wanted to get to, but not quite all the way there. During that time, while I was working in corporate finance, I was studying for the CFA curriculum as professional development because it was applicable to my role. Also helping my parents with their retirement planning, kind of getting that off the ground. They were looking to retire in a couple of years, and also self-educating as much as I could in my free time because I was just super into everything personal finance. So kind of all those knowledge sources together, I guess. I started thinking about, hey, maybe financial planning could be a viable career for me. And while I was helping my parents with their retirement planning, their actual current advisor was sitting in on those meetings, and she kind of pulled me aside afterwards and was like, are you going to do this? Or like, what are your career plans? And I was like, I don't know, I've thought about it. And she's like, you should definitely do that. So that kind of planted the seed. And of course, I didn't want to go push life insurance on friends and family or take any of some of those routes into the industry. So I figured that the best route, the best path forward to do it the way I want would be to launch my own firm. So that's what I did early 2022. And, it's been running ever since. It's great.
Yeah. So I'll ask you a little more about your firm now, what it looks like present day, but it sounds like you didn't even consider, obviously not selling life insurance, you made that clear, but did you look for other firms that did and operated the way you thought you wanted to do to consider that, or you were only like, you're doing your own thing and that's it?
Yeah, I looked around a bit. It was extremely challenging to get anyone to even talk to me because I had, corporate finance experience. I had these credentials, but, they wanted somebody who had kind of grown up in the industry.
Okay.
rather than a career changer. So decided the best path to do it the way I want, to serve clients the way I want, would be just starting my own firm and building it from the ground up.
Yeah. Now, people listening probably don't know this, but you and I met virtually, at least. I think it was Facebook, probably 2020, maybe 2021. We crossed paths first, and I knew the plan you had sketched out for yourself, and I was like, man, this is a sharp dude. You have the CFA, which, for anyone who doesn't know, that's the most difficult designation and credential to get in all of financial services. So like anyone who has that immediately has my respect, and I can tell, yeah, this has got to be a sharp person. But we talked a lot through the virtual world, and I just realized, yeah, this guy knows his stuff. I'm sure he's going to do well in the firm, and I was super excited to see you actually launch. And now, we'll get to where your firm is today, but it's begun things. So I feel like I've known you for a while. I've seen you think through this and get into this, and it's been really cool to watch this happen and come along rather well so far. So kudos to you.
Yeah, thank you. Appreciate that, and appreciate the mentorship. You've always been a couple of years ahead of me, so I can look around the corner and say, like, oh, what's Andy doing? Maybe I'll do that in a couple of years.
Mistakes to avoid. Yeah. So give us a rundown now. Your firm, you said you're based in Dallas, but is it in person? Is it virtual? Who do you work with? What do you do? Fees, et cetera. I mean, wherever you want to go with this.
Yeah, so 7 Saturdays Financial, we're a full-service wealth management firm, which what I mean by that is we do financial planning and investment management. Headquartered in Dallas, but we serve clients nationwide. I think right now we've probably got about 30 to 40% Texas clients, and then the rest of them are spread out across the country. Currently working with about 30 families, and our focus is serving pre-retirees and retirees who want to actually spend their money in retirement. So we'll probably get into that with future questions, but currently a team of 2. I handle planning and investment management, and we've also got a client service associate slash paraplanner. Her name's Marie, and she's an absolute rock star. So she handles the operations, helps make sure nothing slips through the cracks, things like that. And just a couple sidebar details: we're a fee-only firm, so we don't sell any products, and then our pricing is very similar to your model, flat fee. So all in one in dollars for planning plus investment management.
Okay. And I'll be sure, obviously, to link to there'll be a link to 7 Saturdays for people who want to check it out. You can find that in the notes to the show, and also at the end you can shout out any other content sources or things you want to bring people's attention to. Are you? I don't recall. Are you? Obviously, you have virtual business, but even the folks that are in or near you geographically, are they even virtual, or do you have an office or some in-person presence?
So we've got some office space throughout the Dallas area. There's actually 3 locations we can reserve conference rooms at to meet folks at. Okay. So that's been a nice balance. And then we've also got people who are 15 minutes away, but they just prefer to meet virtually. So whatever whatever the client wants.
Very good. Makes sense.
Yeah.
We already got into why or how'd you get into all this, just complete random thing, but what's one interesting fun fact about yourself that's not related to financial planning that people
that's a good one. I went back and forth on that. I think I was always destined to be an entrepreneur because I had a myriad of random business ventures as a kid, the lemonade stands and the stereotypical stuff, but the most unique one was in college. It was breeding and selling tropical cockroaches for reptile food. So I'll tell you how I got into that. I actually had a bearded dragon in college. My girlfriend at the time, my wife now, decided to get that bearded dragon. And of course it was like getting expensive, going to the store and buying crickets all the time. And then it was just an inconvenience. So I started researching online, and apparently there were these South American cockroaches you could just breed in an aquarium and like throw them vegetable scraps, and they would basically just take care of everything for you. You essentially have free food, but eventually the colony started getting out of control, and I was like, what am I going to do here? So I just decided to start selling them on eBay, basically like 25 to start a breeding colony for people. And it was cool, man. I had like the hand warmer packs. I would tape it to the side and make sure they were warm enough to get where they're going and not die on the way. So it was a nice little college venture, extra walking around money.
Interesting. Now, I know nothing about that. Did you need any sort of special license? I mean, if you did, maybe you didn't get it, but like to ship live insects?
Maybe, not to my knowledge at the time, though.
Right. Yeah, not that. We'll pretend not then. It wasn't required then. All right, cool. I did not know that. Thanks for sharing. All right, let's get into some of the general retirement planning type questions. What do you think is an area of retirement planning that too many consumers overlook or don't give enough attention to? And then sort of flip side of that, what's one area you think they give too much attention to in the process?
Yeah. This is probably one of my favorite questions that you ask, but probably very similar to your firm, Andy. But most of the clients that I work with have built their wealth through decades of frugal habits. So retirement can be a really tough transition. I think the aspect that people don't pay enough attention to would be mastering the art of spending. So, they spend their entire careers turning income into assets, but now they need to flip that switch from saver to spender and turn those assets into income after the paycheck stops. So one of my favorite analogies is actually Aesop's fable of the ant and the grasshopper. So for folks who haven't heard it, basically the industrious ant works all summer gathering food. He's planning ahead, and then the grasshopper is just carefree, playing and not preparing for the future. And then eventually winter comes and the ant survives, but the grasshopper's in dire straits. So I think it's a really good analogy for retirement, because most people, or many people anyway, are great savers during their career. Like the ant, they're masters of delaying gratification and preparing for the future, but come retirement, they need to be just a little bit more like the grasshopper when it's finally in time to enjoy the fruits of their labor. So I think research shows about 60% of retirees actually withdraw less than their investments earn in retirement. So effectively, they're still saving money in retirement.
Yeah.
That's when they're, typically you would expect them to be spending money. So, that's one of my most interesting, the parts of retirement planning that I find the most interesting, I guess, is kind of that retiree underspending. They don't spend or gift up to the capacity that they could. And, many people just unnecessarily deprive themselves of experiences and comforts that they could have easily afforded.
Yeah. Now, I think this is actually a question I was going to ask later, but that is a big issue and hard to deal with, and something a lot of people struggle, consumers and advisors struggle to find a solution to that. Is there anything in particular you do, or what have you found that's had some success in helping people get over the mind shift change and being reluctant to spend their assets, even if, objectively speaking, they got plenty enough to go around?
Yeah, and that's, there's a lot of different tools that we can use as advisors. It's really a tough nut to crack, right? What's going to work for one person may not work for another one, but, to get them kind of nudged from that ant side of the spectrum towards the grasshopper a little bit, we can use dynamic withdrawals, aka guardrails. Some folks may or may not be familiar with that. We can dive into that in a bit, but that's one tool that I think can help folks. Another one is an income tilted portfolio, so like a dividend income strategy, right? Most financial advisors know that total return approach is what it is, but I think there are some behavioral benefits potentially to an income tilted portfolio. A couple other things that can work or can help nudge people to actually spend is having more protected income. There's a lot of research out there that shows the more protected or stable income, like from pensions and annuities, the more comfortable people actually feel spending money, which makes sense. And then there's, mental accounting. Like we can use that to our advantage, right? So for some folks who have trouble spending on themselves, I like the idea of creating a separate checking account, and we're going to call that your travel fund, or we're going to call that your fun money fund. And then every quarter money goes in, and the objective is to empty it, right? So kind of using mental accounting to our advantage with that strategy.
Yeah. Well, it makes a lot of sense. And I agree. Those things can definitely help, maybe not solve the equation, but at least get a lot of the way there and helping people minimize their reluctance to spend. So,
yeah. And there's actually a story about one of my earlier clients that really had a lot of trouble spending. It was a newly retired couple. The husband was just super anxious about spending. They had plenty, but he was so concerned with nickel and diming every single expense that, he was even scrutinizing the daily Starbucks purchase, which, $5 a day is probably not going to move the needle on a retirement plan. So as a result, he wasn't enjoying retirement, which meant that his wife wasn't really enjoying retirement either, as a result. So we started working together and developed a plan that they could both be confident in. We used a couple of the tools I mentioned, like guardrail strategy for retirement paychecks, which really resonated with them. And then we also helped them shop for income annuities. They had a really high fee product that wasn't that great, so helped them roll that into a product that had a higher payout rate and made their retirement income plan look better. So after a few months, he started to realize that he could actually spend money and enjoy this next phase of life. And then one really big milestone for them was I recommended he actually read Die with Zero. That's one of the books that's talked a lot about in your Facebook group. I'm a big fan of it, but one of the ideas in there is, taking your family on big memorable trips when, if you have the surplus to do that. So he ended up taking his kids and grandkids to Hawaii for his 70th birthday. It fit in the budget perfectly. And, at the end of the day, I have to imagine that when he's 90 years old, he'll probably appreciate those memories more than an extra $30,000 or $40,000 in the investment account, right?
Yeah, exactly. That is a hard balance. Easier said than done, right? I don't think anyone objects to the idea of its memories that ultimately, for most people, at least, give you value, give you things to look back and appreciate that you did and enjoy and not regret not dying with an extra $30,000 versus what you otherwise have. But when you're 60, 65, don't know how long you're going to live, and even though you have a lot of money, you may be like, oh, how do I know this is going to last 25, 30 years? So it's a hard balance, and I don't have the answer. I'm just, start talking out loud here. But people who take those experiences, who do those trips, definitely don't regret it. So to the extent you can use those as sort of data points or anecdotal stories that, look, Mr. and Mrs. So-and-so who's reluctant to spend money, here's some stuff to consider in ways in which you can get some use and value out of your money and hopefully, not regret doing so.
Yeah, absolutely.
Going back to the flip side of that question, is there anything you feel people put too much focus or emphasis on with regards to retirement planning?
Yeah, there's a lot of good things got a lot of good options to answer that question with, but I think the one that I would answer is making the decision to claim Social Security purely a math problem. A lot of folks can fixate on break-even age or what's the IRR of this decision, internal rate of return of this decision, and really take the textbook approach. And there are situations where it matters, right? Like if, depending on one's resources and goals, if there's abnormal life expectancy, the decision between 62 versus 70 can have a big impact on the plan. But for most of the retirees I tend to work with, those with 3, 4, 5 million or more, Social Security is typically a small portion of their total retirement spending capacity. So it doesn't really move the needle, and it's certainly less important than like tax strategy or making the right investment decisions. So I like to ask the question, what would you do with the money if you claimed early? So if folks would just turn around and put it into the investment portfolio, that's one thing, maybe consider delaying, but if they take that income and they'd actually spend it, early in retirement when they're healthy and mobile, kind of front loading that travel and those experiences, that's a very different story. And that strategy might be suboptimal from a math perspective, but, obviously better to maximize those life experiences if that's something that's important to the person.
Yeah, fully agree. Social Security is something where people who are very numerically focused, often engineers, et cetera, really want to boil it down to as objective as a decision and analysis as possible. And you just can't. There needs to be some sort of subjective, qualitative things folded in. Well, to the extent it applies to them, those subjective, qualitative things. But any article that says you have to do this or the break-even's the only way or whatever, just tune out that noise. Yeah, there may be some relevant things to consider in what's discussed there, but that isn't the end-all, be-all.
Yeah.
Great point. For folks that do choose to work with an advisor, be it yourself or anyone else in the industry, what questions do you think they should ask, things they should focus on, types of diligence that should be done in that search process?
Yeah, so I think about that in two categories. So the first one is like filters, or what to look for before you schedule a meeting with them. And then when you're in a meeting with them, there's certain questions you ask. So I'll start out with the filters. I recommend people start with an independent advisor. They're not associated with any big banks or big brokerage firms. Those firms typically sell a lot of products. Oftentimes they're limited to only the products that their firm approves, which means, those products may not be in the best interests of the clients. Another important filter is fee only. So no product sales, obviously a lower conflict of interest model. Every model has conflicts of interest, I'll admit that, but the lower we can get those conflicts, the better. Credentials are important. Obviously the big three are CFP, CFA, and CPA. So CFP is kind of the gold standard for financial planning. CFA is a little bit more catered towards investment management, and CPA is more focused on the tax side. So I would say is, good for an advisor to have at least one of those three, very respectable credentials. And then finally, the specialty. Are they a generalist? Do they work with everybody, or do they specialize in working with people just like you in your situation?
Those are good. Really good.
Yeah.
I agree with all of those. So well done on that list.
Yeah, thanks. And then once you're in front of an advisor, you're having a meeting with them, I think there's a few important questions to ask. one of them that's really, you can really glean a lot of information about is how many clients do you serve. So if that number is less than 100, you're probably going to get a lot more in-depth planning than if that number is 300 or more, right? There's just not enough time in the day to tackle all the planning topics if they're having 8 meetings a day, for example.
Right.
Another question that's kind of a litmus test, if you will, is asking them, what documents do you request from me before we get started with planning? So, if it's very short, if it's just investment statements, if tax returns aren't on the list, that can be kind of a yellow flag there. And then, of course, you want to understand what it costs in dollars to work with them, right? So if somebody quotes a fee in percent, you want to take the next step and just calculate actually what that's going to be in dollars, so you're fully informed before you sign on the dotted line, so to speak.
Yeah. I just had a discussion about fee models with a few other advisors at a small little symposium / panel in outside of Washington, D.C. And that came up. I mean, I brought it up because I bring it up more than I probably should, but like, know what you're paying and know it in dollars. As much as we in the industry think percentages are easy and we can quickly do 1% of whatever, or even 1.25% of whatever, 1.5%, a lot of people, even super smart people, just simply don't and struggle with basic math behind percentages unless they pull out a calculator. So I can't tell you how many people I've come across, current clients or potential clients that I've had like intro calls with, where they say they don't know what they're paying. I'll say, I don't know, it's 1%, 1.25%. Well, how much is that? They go, oh, I don't know. Wow.
Yeah.
Is it 15 grand? Is it 40 grand? Like, people really have no idea. So know what you're paying in dollars, regardless how you're paying, know what it is in dollars. Great insight there. Okay, so what do you do to learn stuff, to stay fresh on stuff you already know, to keep up with ever-changing tax laws or anything that changes relevant to what you do? What's your favorite content sources?
Obviously, this podcast would be number one.
Oh, of course, right. Yeah.
So we'll get that out of the way. But Kit's blog is, I would say, like, way up there. So I mean, that's kind of the Bible for financial planning content. So anything tax related, anything super technical, Kit's is fantastic, and they're actually starting to do more of the behavioral aspects as well, and practice management. So it's becoming more comprehensive. So highly recommend folks check out kitces.com, KITCES, and I'll give you 3 others. So, big fan of Ben Felix. He does the Rational Reminder podcast. I think he's based in Canada. Ben Carlson, he's got a Wealth of Common Sense blog, and I like to actually reference some of those articles in my newsletters. And there's another one, Oblivious Investor. That's Mike Piper. So a couple great blog resources there. Excellent.
Yeah, I've heard of 2 of those. I don't think I've heard of Ben Felix. I'll have to look into that. But
oh yeah,
good to know.
Great resource.
All right, so now let's get into some more specific-ish things about your practice, not general, just retirement planning thoughts. Regarding working with people, how do you know if someone is a good fit for you to work with them, as opposed for you being a good fit for them to work with you?
Yeah, great question. And sometimes folks forget it's kind of a 2-way interview process. But 2 key characteristics I like to keep in mind are, I would like somebody I work with to be personable and productive. So I'll explain those. Personable is kind of a little bit easier to understand. Are they polite or are they rude? Do they ask thoughtful questions? Are we able to communicate effectively? Ultimately answering the question, is this someone I'd want to work with for the next 20 or 30 years? And then the productive side is not necessarily them as a person, but the relationship. Do their needs align with our expertise? Do I see opportunities for us to add value that exceed the cost to work with us? And then do we align on investment philosophy and their expectations for what working with an advisor might look like? So kind of like, is it going to be a productive relationship in the context of financial planning?
Yeah, those are great. And that's one of the good things about working with a smaller, more hands-on, intentionally, wanting to keep it a more personal practice, is that it is a 2-way street. A lot of the larger places, clients are just numbers, and there's production targets, and anyone who can fog a mirror is a good potential client, right? Like, that's all they really care about. And do you have assets to roll over? But that doesn't make for a good relationship necessarily, and it oftentimes doesn't. working with a small, more intimate relationship like this, and I can say the same thing firsthand, and I know you're the same, like it really does matter. You want to be selective who you work with, that you can actually provide value, that the people are actually aligned with what you do. They're going to be responsive when you need stuff, just like you're responsive when they ask for things, or stuff comes up. So good. I'm glad to see there's more of us smallish places out there doing real planning with real relationships that aren't just meat grinders of trying to hit certain targets or hit figures.
Yeah, 100%.
Now, not every relationship ends up being perfect throughout time. Some clients voluntarily leave for whatever reason may be, or sometimes we as advisors voluntarily part ways with clients. Have you ever had to, and if so, are you willing to disclose the high-level circumstances around why you took that decision?
Yeah, for sure. So I have had to part ways with clients before if they're no longer a good fit. A great example is I had a guy who came in, had kind of a normal situation, but as we started working together, the months went on and he was just super interested in real estate investing. Like that's where he was going to go. And he decided like he wasn't going to invest in like traditional assets anymore. He was going to put everything towards real estate. And, I know enough about real estate to be dangerous, but that wasn't my expertise. And, kind of the fiduciary duty I explained to him was, even if this isn't in my best interest, like obviously if I refer you to an advisor who is more real estate specific, I'm not going to be collecting your fee. So it's against my best interest, but it's what's best for you as the client. So that's what I ended up doing is referring him to one of my colleagues who focuses on that specific area. And, they're working together great. And he's being served to the capacity he needs to be.
Awesome. Yeah, I'm glad you brought that up about fiduciary duty. It's not just making sure you stay a client, but also know your limits. If you're not the best suited to do that, well, what is it? The responsibility of prudence or something? I don't know what the word is, but if you're not going to be able to be the one to best serve them and whatever their needs and requirements are, you owe it to them to basically step back and be like, I'm not the expert in this, and find someone who can, or if you were to bring in outside experts to help and whatever, if that's the way you choose to go about it. But I've done the same thing. Real estate's one thing where like, yeah, I know enough about it, I can get through it, but it's really not my specialization. I don't know what I don't know.
Yeah.
Some of the nuances and the tax treatments and stuff. So you owe it to clients to step away at that point. Like, I'm not the best one for you, but let me try to help you find someone who is better suited. Good job there.
Yeah, I think it's like a cardiologist versus a knee surgeon, right? Like they're not going to cross paths. You're going to refer for the specific problem that they have. Yeah,
like I know how to cut a body open, right? Like I can look at some bones, some tendons, but am I really the best one being there fishing around? Probably not.
Yeah.
Investment management. What's at a high level your view and approach on how you put together portfolios and your thoughts and philosophies around investing?
Yeah, so there's a lot of different ways to tackle that, but our investment ethos as a firm has 4 key principles. So we like to diversify globally. We're not placing concentrated on bets on any single country. We like to minimize costs and taxes. So obviously the lower cost your funds are, the more you keep in your pocket. Taxes are obvious. We rely on academic principles, not fads. So we're not out there trying to pick the next NVIDIA or, day trading Bitcoin or things like that. We want investments that work, not the fads that are out there. And then the last thing is avoid trying to outguess the market. So, there's a potential government shutdown on the horizon right now, and we're not going to play with portfolios and try to guess how the market's going to react to that. So I think that there's a lot more risk to that than a lot of folks realize. So essentially, since we know that market downturns will happen, probably several times during the course of a normal retirement, our approach is to create a plan and a portfolio that are prepared for those downturns and not derailed by them.
Yeah, and it's important to note, you're not, everybody should invest every cent and that's it. Like you mentioned before, you help people maximize guaranteed income if and when necessary. So I just want to sort of front run this question a little bit. A lot of times I get flack from folks often who only sell insurance to be like, well, the client's portfolio lost 20%. That's on you. They're in retirement. They can't afford to lose money. Like, no. Like, step back, look at the bigger context. Like, they have more than enough guaranteed income, for example. This money that they're investing isn't necessarily for them, or if it is, it's for them in 20 years, or it's for their kids who are only 30 or 40 who still have decades of timeline. Just because portfolios went down doesn't mean you're not acting in their best interest and not still doing right by them. To your point, structure a portfolio where you're not doing undue harm to them with potential downturns or whatever, knowing it's going to happen, right? How much can they be able to face if and when it does happen, given the context of the bigger picture? So,
Yeah.
Rambling sort of answer there, right? I just wanted to sort of put that thought out there.
Yeah. No, that's a great point.
Benchmarking. So sounds like we didn't say this, but are you invest in typically passive-ish stuff? I know you're into single stock picking, but the funds you do use, what types of funds would they generally be?
Yeah, we use a mix of totally passive and kind of like you described, passive-ish. So some of those funds that are a little bit factor tilted, like tilting towards small value. Some of the areas that historically have shown a little bit of outperformance. Again, you're not going to be trying to swing for the fences in retirement because it's all about avoiding strikeouts, right? So if there is any outperformance from those factor tilts, it's going to be modest, right? Like maybe it's 0.25% or maybe it's 0.5% on a given year. And of course, there's times where those factor strategies underperform as well. So, pretty close to market-based returns, I would say.
Okay. So with that, knowing that you're more or less shooting for market-based returns with your portfolios, maybe slightly more, maybe slightly less any given year, do you do any sort of formal benchmarking of returns of your portfolios for your clients versus some other hypothetical portfolio or specific benchmarks or indices?
Yeah, I've thought about that quite a bit, and we don't do any formal benchmarking. We do review client portfolios internally just to compare the overall market and the performance is what we would expect. But ultimately, there's going to be a wide variety, client to client. So it's hard to pick a benchmark. Somebody who's in a 60-40 portfolio is, you can't compare them to the S&P. You can't compare an 80-20 portfolio to the S&P. So it's like, what do you pick? And then oftentimes they have those legacy positions that they came in with, in a taxable account. We're not just going to sell those and incur a huge tax event just so we can cram them into our model portfolio. So those legacy positions, they'll introduce some tracking error as well. We make sure that the concentration risk is not enormous, but we kind of balance the tax impacts versus tracking the market as a whole. So I guess to summarize it, I'm more concerned with making sure a client's goals and financial plan are on track relative to like the Bob and Sue retirement index than if they beat a benchmark that's somewhat arbitrary. And sometimes I'll have prospective clients ask about that, like, hey, what are your returns? And that's such a loaded question, right? It's like, well, how much time you got? But I think one of the most effective ways to communicate that is, hey, picture this: if we work together and somehow we're able to beat the S&P by 2% every year, like we're the world's best stock picker, we beat the S&P by 2% every year for your entire retirement, but your portfolio is too aggressive and you end up running out of money halfway through retirement. Did we win? We beat the S&P by 2% every single year, but we didn't hit the goal. So that's kind of like putting it in perspective for folks.
Exactly. It is a hard question, and we as a firm had this question a couple months ago and had to basically get on a call to talk through it, because I'm not trying to be dodgy, but we can't simply give an answer of like, what have your returns been, like returns of the firm across all 100 clients and aggregate it. Like, that's not meaningful. Right. Returns of any one client, that's not meaningful. Like, your goals and objectives and risk profile and investments are going to be slightly different than theirs. Returns versus the S&P, that's not meaningful unless you're intended to be in a 100% stock portfolio of large cap companies. Like, the S&P is not an appropriate index for you to benchmark against. So I always feel like fishy and coming off like I'm trying to back my way out of answering the question. Like, I swear I'm not. It's not for as harmless and as innocuous of a question as it sounds. There's really not a good answer for the way we do things, right? Like, if you're managing a mutual fund where everyone invests in the exact same commoditized, homogenous product, then yes, you have to report the returns of that fund. The way we do it, like, everyone's accounts are a little different, so everyone's returns are going to be a little different for their own unique reasons. So what is success? Like, it's hard to say. How exactly do you define success in investing here?
Yeah, and to kind of piggyback on that, it's like, do you want pre-tax returns or after-tax returns,
yeah,
right? If it's a taxable account, we can look at it that way. We can do tax loss harvesting, right? There's a million ways you can slice and dice that.
Yep. Do you have performance reporting software if clients want to actually see returns of accounts?
Yeah, we do, but a lot of our clients just don't find value in it. They see the account statements, they know what their portfolio is doing, and we review it twice a year with them. So really more focused on, is your plan on track? Are you going to achieve your goals versus did we get 9.25% or 9.5% last year?
Exactly. I agree with that. Okay, annuities. So we already sort of got into this. You do, some folks are fundamentally opposed to annuities. You clearly not, and I'm with you. I think they're a tool. When the tool makes sense, they need to be visited. Otherwise, if they don't make sense, then no. So I guess knowing that you do recommend annuities when they make sense, knowing you're fee only, you don't actually sell, like how do you go about helping clients shop for and then ultimately consummate the purchase of an annuity when the time comes?
Yeah, I can't believe you said the A word on air. Isn't this a family program?
Yeah.
Seriously. No, annuities are extremely divisive topic. A lot of folks are like, won't even talk about them, but other folks are kind of curious, and it's like, well, it depends. How does it look in your plan with an annuity versus without? So really depends on clients' goals. Kind of to your point, Andy, they're a tool, right? Like a hammer. You're not going to use it to, put in screws or lay flooring, but if there's a job that calls for it, it's a great tool for the job. So they can be especially helpful for retirees who don't have a pension but want more protected income, more stable income than what Social Security pays up. I always bring it up in client conversations, and we talk about the pros and cons. So some of the pros are that, if it's an income annuity, it's income that can't be outlived, right? Even if you live to 115 years old, those checks aren't going to stop coming. It's a more stable income experience in retirement. So back testing a plan, it can often result in higher income earlier in retirement when folks are more healthy and mobile and spending that money. And then, like we talked about, behavioral research shows that more protected income often means that folks are actually comfortable spending their money in retirement. So that's the pros side. But like anything in life, there are trade-offs, right? So the cons, we make sure that people understand these fully. It reduces liquidity and flexibility. If you write an insurance company a check for $500,000, you can't do anything else with that money, right? You can't go buy an RV. You can't do multitude of things with it. I think it's reasonable to expect that you will probably die with less money if you buy an annuity versus if you don't. And you also want to consider taking a balanced approach. So you want to keep enough in growth assets invested in the portfolio that you'll fund those inflation adjustments over the course of your retirement, because the majority of annuities are level payout. They don't increase over time. So you need those inflation bumps to come from somewhere. So if we decide, we sit down with the client, we look at their plan with versus without, we look at back testing it, what would have happened if you retired right before the Great Depression. Okay, here's the normal case versus here's the annuity case. Let's see how your income experience would have been. So we can look at kind of the A/B test there, and then we've got some trusted partners that we refer to. We tell them exactly what sort of products we want to shop across carriers, and they're not out there trying to upsell the client. It's all through the advisor. We're kind of the BS screen, for lack of a better word.
Good. And so far, you've had good experiences with that process, and however many clients you've had get annuities.
Yeah, it's been great, and the folks that have pulled the trigger on it, they're not looking back on it regretting it. They're just feeling confident about their spending.
Good. I think that's it. When you make an informed decision, especially with an outside trusted partner like yourself, to kick through, does this really make sense? Is this the best product? The potential regret and post-purchase dissonance, or whatever it's called, is so much lower versus someone who randomly gets a mailer in their mailbox, shows up at a dinner at season 52 about retirement income planning, ends up it's just someone trying to sell everyone there an annuity. There's a decent chance once you find out what you actually bought, you might not be so okay with that purchase. But going through the route like you and folks like you who don't sell annuities, you're just there to say, does this make the most sense for you, yes or no? It really does a lot of service and justice to the product.
Yeah, and that kind of speaks to the planning first approach as well. I know you do it very similar, but we should do very in-depth planning before we even talk about products versus,
right.
Like you said, the steak dinner. A lot of times it's just like, hey, here's this magic Swiss Army knife that fixes all your problems, no matter what your problems are, right?
Yeah. It should always be start with what's the problem and then what's the solution, as opposed to a lot of places are already out selling with the solution first, trying to back into a problem to justify buying the solution, which is the wrong way to go about it.
Yeah.
Okay, let's talk about trust, specifically the living/revocable kind. I'm still trying to make my mind up. I feel like I want to get sold on these and come to a conclusion that yes, most people or everyone should get them. I'm not there yet. What do you think? Now, granted, this is state by state specific. What are your thoughts and views or recommendations around trust?
Yeah, it's like you said, it depends, right? That's the classic answer for planning, but depends on the state. Some states are really easy, like Texas is a very easy probate process. So I'm less inclined to recommend a trust for somebody in Texas versus, California or some of those states where it's very expensive, it's very time consuming. You can really do your heirs a favor by kind of doing that upfront work and spending a little bit of money to make their life easier during that difficult time. Family-specific factors come into play, of course, if they want privacy around their assets. Probate is a public process, so anything that's in the trust is private. Doesn't really get people in your business, but there's also like the control of the timing of distributions. So this is more of a factor with younger families. If you've got minor children, you may not want several $1,000,000 dropped in their lap the day they turn 18. But for folks that are retired or close to it, it's less of a concern of timing distributions like that. But there may still be some things that they want to control as well. If they've got a child who's maybe a spendthrift and another one who's responsible, maybe there's a trust in there that makes sense.
Yeah. Another aspect that a listener emailed me about a couple months ago to consider, and another potential pro for living revocable trust, was incapacity, not even death and probate, but incapacity. So the example was, he forwarded me an article, which almost seemed like too extreme and didn't believe it to be true, but I guess it's possible, where the person who died or became incapacitated had a bank account, had a brokerage account, whatever, and had powers of attorney set up for the person's incapacitation. If they couldn't act on their own, then so-and-so would step in as a power of attorney and be able to, make decisions in those accounts for them. Now, both institutions, both the bank and the brokerage, would not take just a general, broad, legal document. They wanted their own specific forms. The bank had their own form, the broker had their own form. So client filled those out and said, okay, yes, I designate whatever, Jane Smith to be my power of attorney if I'm incapacitated. And this is part I don't quite understand how it happened. When the person did actually become incapacitated, the bank claimed they lost the form because it was from 10 years ago and there was a bank merger and whatever. And I forget what the brokerage story was. But point is, they're we can't honor these apparent powers of attorney you have. If it was in a trust, so I'm told, from what I think I understand, it'd be much easier because a trust not only stipulates what happens to your stuff after you die, but also addresses incapacitation. In that case, the trustee or whoever else you name, you're incapacitated now in theory. The trust is the one who owns the account. I guess you have to prove to the bank and the brokerage that, yes, this person is incapacitated. I'm the trustee. Here you go. I'm told that could be a much more smooth and less potential to be challenged or rejected process than just the old POA route. So assuming that's accurate, that is another feather in the hat of why and how trust can make sense.
Yeah, that makes a lot of sense, and that's my understanding of it too. And to your point about the institution-specific POAs, a lot of people will just have a generic POA, and good luck. Like if there is an institution-specific one that they need signed and you're incapacitated, you're probably not going to sign it. So really, I could see where that would put people in a lurch, and that would tilt a little bit in favor of the trust route versus the power of attorney route. But obviously, a slim chance of that happening, right? In most cases,
right? You would hope it's okay. So we did that. I did that with my mom. This was it's pre-COVID, so I don't know, 6 or 7, 8 years ago. She had all her estate documents redone, added me as a durable power of attorney, and it wasn't even springing. It was even while she's alive and completely mentally with it, I can still act on her accounts. I don't, but I have the power to. And so her bank was Wells Fargo at the time. We went there. She said, I just want to let you know, here's a power of attorney. Here's my son with me, who's the named power of attorney. I want to make sure you guys are aware of that and add him to the account. So I go, we don't accept generic legal powers of attorney. Go, excuse me? She had relatively high-powered, well-established 50-year-old law firm in New Jersey who does this all the time, draft it, execute it, and say, yes, this will work. Banks shouldn't not accept this. Wells Fargo was sorry, we don't take it. Not a big deal. They just printed off their generic power of attorney, which she and I signed on the spot, and they have that on file, assuming they still have it. All is good. But just cautionary tale, if something happened to my mom, we did not get the Wells Fargo specific POA on file. She was incapacitated. I show up at the POA doc, sorry, we don't take that. Now you're stuck, right? They're not, what are you going to do? So for everyone who has generic POAs and think your banks, your brokerages, your whatever will accept them. Confirm it first before something happens, because if they don't, you want to address that before it's too late.
Yeah, I feel like there should be some consumer protection around that, where they have to accept, if it's valid, if it's notarized, like,
Exactly.
I don't see how they can turn that away. That's kind of bogus to me.
I mean, one thing if it's written on a napkin, like, come on, really? But like, if it's a well, clearly thought out, again, done by well-established, well-respected attorneys where this is all they do, duly notarized, whatever, like, I don't know how they wouldn't accept it, but they said, nope, we don't do it. Anyway. Okay, long-term care planning. How do you approach this? Do you potentially recommend or consider insurance? Or I know some clients can self-fund, but it's a big bear to try to tackle. What do you do with it?
Yeah, this is a big wild card in most retirement plans. A lot of retirees are concerned about it, but it's kind of like picking the least bad answer of how to fund it. So, like, depending on which study you read, somewhere between a third and a half of retirees spend $0 on long-term care during their lifetime. So it can be really difficult to justify spending thousands of dollars per year insuring against this event that has a decent chance of not happening. So, and then, of course, like, knowing that your premiums are probably going to spiral out of control at some point. We've all seen those letters of increase and reduced benefits. But we talk about long-term care as part of our planning process, and discuss with clients what's a reasonable range of what care might cost based on where you live and the type of care that you might need. So many of the retirees we work with have more than enough to self-fund. So many of them decide to go that route, but others want to transfer at least some of the risk to an insurance company, whether that's 1 year of half benefits or 2 years of half benefits, at least taking off the sting if a long-term care event does happen. So we'll, very similar to the annuities, we've got a trusted broker that will shop across carriers and find the best rates for their particular situation. But one thing that's interesting to a lot of clients is those hybrid policies, because although they're not as rich when it comes to either death benefit or long-term care benefit, because it is somewhat of a Swiss Army knife, they at least have that backup. If we end up not needing $1 of long-term care, there's a death benefit, so it's not like we feel like we wasted 20 years of premium. So that's kind of an interesting option as well.
Yeah, because traditional long-term care is use it or lose it. It's sort of like homeowners insurance, right? Like, you don't get anything back if you don't have a event where they step in and cover the damage or replacement of your house. Like, which I think, people get that and understand that with property and casualty insurance, like homeowners and autos. You pay for it, hoping to never use it. Long-term care, people feel a little different. Like, you don't want a long-term care event to happen, but it also stings to write $3,000, $4,000, $5,000 a year premium checks for however long and never use it. So the hybrid policies, like you said, could be a decent solution. It's life insurance first and foremost, and then with a long-term care rider tacked on, where if you do have a long-term care event, you basically start spending down or using some of your death benefit in advance, so there's less death benefit to go around. And the benefits aren't as generous usually, but it could at least take the sting off, and it's not like it's use it or lose it. You get something one way or the other. If you do have a long-term care event, you get benefits that way, or if you don't and you end up dying, there's a death benefit payable to heirs. So something worth considering for people that's important for.
Yeah. Have you seen some of the tech solutions that are coming out? There's, I was at a conference this weekend, and there's one that uses AI, and it uses, I think they said 500 million data points based on the client specifics, to narrow kind of the range of expected outcomes when it comes to long-term care. So rather than looking at the population as a whole and saying, you might need between $0 and $2 million, based on their demographic factors, their medical factors, things like that, try to narrow that range up and say, we're 90% confident if you need long-term care, it'll be in this range. So can help the planning process a bit. So we're looking at that for our firm.
Interesting. Yeah, I don't know if it's the same place, but I was at the same conference you were at this weekend. I was at a year ago. I mean, you were there as well. And there was, I think it was that conference, there's someone from one of the vendors floating around. He didn't have a tent or a table, but he was doing like preliminary research. He had this idea spec'd out. And it sounds very familiar what you're talking about, like data points where you would sign up for their service and you can get more sort of refined projections of each client's potential expected long-term care likelihood and usage. But at the time, it was just like exploratory to see, is this even feasible? Would advisors even consider it? So I guess they've gotten past that point. It sounds like now it is more built out, if it's the same one I'm thinking of. But I'll have to look into that. That's interesting.
Yeah, it is.
Cool. Distribution plan. So we sort of talked about this in a few different spots already, but I don't know, where do you want to go with this? Do you have like a firm deliverable for everyone? Is there kind of a basic process you use as your starting point and then tweak as necessary for folks or whatever?
Yeah. So our distribution planning actually starts before folks become clients, during the interview phase. So we've got a complementary analysis we call the retirement roadmap. What that is it's a 3-meeting process to show potential clients what it's like working with us, how we think, the type of recommendations we make, and ultimately where we can add value. So kind of helping them make an informed decision about our firm or any other firm they may talk to. So key areas of that are retirement income, lower taxes, and investing smarter. So that's the key areas that we drill down on. So as part of that retirement income piece, we get an understanding of all their resources like Social Security, pension, other income sources, and based on their investments as well, we'll walk them through a guardrail strategy, kind of a rough sketch of what they could expect to spend in retirement safely and sustainably. So kind of avoiding the overspending or underspending extremes that can often happen in retirement with that guardrail strategy. So that's the potential client phase. If they choose to move forward, then the next meeting we'll discuss how to tactically construct those retirement paychecks. And I mentioned like the annuity versus no annuity case. That's a common scenario we'll look at, and we'll also look at stress testing the plan. So the guardrail strategy looks great, but what happens if there's another Great Depression or another 2008? Well, with the benefit of hindsight, we can actually stress test the plan through that and see what the income experience would have looked like going through those time periods. So that's really insightful. Folks really like going through that stress test. But once we decide on an income plan and a path forward, we'll implement it, monitor it over time, and of course review it in meetings with clients. But letting them know proactively when an income adjustment is needed, whether that's down or upward. Hopefully upward increases in retirement. Okay. And the whole goal of it is I really don't want clients to have to decide whether or not to order dessert with dinner based on what the stock market did that day. So, kind of get the retirement paycheck set up and monitor them over time for anything that may need to change.
And just curious about the guardrails, without getting too technical in the weeds, there's a few different ways to implement it. One is just like, if your total portfolio size increases by 20% from what it is now, you can increase your distribution by whatever, 10%. Or if it goes down 20%, you decrease your distribution by whatever. Another is more like risk-based, where the thresholds aren't just a flat percentage increase or decrease in your portfolio size, but some like behind-the-scenes measure of risk, or I don't know if it's Monte Carlo or whatever, but can you just sort of talk through what your process uses?
Yeah, great question. So we use risk-based guardrails. It's Income Lab is the software, but yeah, under the hood, if you get into it, it's just a Monte Carlo engine running, and then it's constantly testing what keeps the plan within, or what portfolio size keeps the plan within those acceptable risk guardrails. So those income adjustments are meant to keep the risk of the overall plan, not just the portfolio, but considering their pension and their Social Security and things like that, keeping the risk of the overall plan within those bounds.
So it's not just portfolio size goes up or goes down by X, but Monte Carlo result goes up or goes down by some amount. That's what drives the distribution changes, the income changes?
Yeah, so it is portfolio size that drives the income changes, but the retirement paychecks are based on holistically like all of their income sources along with portfolio distributions. So I think that there's a lot of folks that do it with a spreadsheet, which is great, but I have concerns about that. Like if you're not taking Social Security and then all of a sudden you do take Social Security, like are you going to increase your spending by $50,000 a year just because Social Security came in, or do you want to levelize it more and kind of smooth the income?
Right, and risk-based captures that, right?
Yeah, correct.
Yeah, excellent. Okay. Regarding tax planning, what's some common opportunities you come across with clients? And we'll not talk about Roth conversions. I think that's so beaten beyond death. But above and beyond Roth conversions, what are typical things you do or see?
Yeah. So I'll give you 3 examples of things areas we often focus on. The first one is many of our clients are generous and make annual donations to causes they care about. So charity's great, but if you can do it tax efficiently, even better. So we talk a lot about those strategies, like donating appreciated securities instead of cash. If they've got some positions that have big embedded gains, it's obviously good to get rid of those, shed those instead of cash. We also talk about bunching deductions in a single year. So oftentimes folks can front load the next 2, 3, 4 years of charitable giving and get an enormous deduction in the given year. And using a donor advised fund to facilitate that, kind of the holding tank for those charitable distributions. Those are very, very common tools that we use and oftentimes help people make a bigger impact to those causes they care about by paying less to Uncle Sam.
Yeah.
The next strategy is if clients are still working for a few years before retirement, depending on their tax situation, we'll look at their employer retirement plan, see if it accommodates what's called the mega backdoor Roth. So, is there an opportunity to cram a bunch of after-tax contributions in there and convert those to Roth immediately? That's a pretty solid way to get like an extra 50 or 60,000 a year into that Roth bucket, even before retirement, before you start talking about things like Roth conversions. And then the last one.
Don't talk about Roth conversion. Roth what? Don't talk about Roth conversion.
I said the Roth would.
Right. Yeah, the C word.
Finally, one of the other important activities we do for clients is reviewing tax returns every year. I know you do that as well, and it's just critical for financial planning, not only for information and spotting those planning opportunities, but also being a second set of eyes on the client return. So, if I know everything that happened in a client's life financially last year and I see something on the tax return that doesn't jive with that, hey, that's a great conversation to have with the CPA. Maybe something got missed, maybe something was misreported, but one specific example is we have a client who is pretty heavy into business ownership. So the businesses that he's involved in are kicking off a lot of interest income. And, the NIIT, that additional 3.8% investment tax, applies over a certain income threshold, but it only applies to passive income. And we looked at the tax return and we're like, why is he paying so much in NIIT? Well, it was categorized as just normal interest income, like if it were coming off a checking account or something. And, went back to the CPA. She was great. She was very receptive to a conversation about, hey, this is actually in the normal course of business. I think this is active income. I don't think NIIT applies here. So we're still waiting for like a final determination, but potential for him to save a lot of money based on that. We reviewed his tax return and spotted that thing.
Good, great find. And there's a reason why it's so important for advisors. I mean, they have to have some tax acumen, obviously, but to be reviewing your tax returns, even if they're ones not to do your returns, there's so much value to be had and things that could be spotted and planning opportunities to see in there. So if your advisor/planner is not asking for your tax return, you should first ask them why, and then maybe consider working with someone who does take a dive into your return routine.
Yeah.
Cool. Okay. Anything else on the tax planning thing?
That's the big ones. I won't talk about the C word.
Don't even go there. Don't even go there. No. How do you help determine if clients have, quote unquote, enough for retirement? What tools, rules of thumb, litmus tests, back of the envelope math, whatever do you use in coming to that conclusion, if that is a conclusion?
Yeah. So, rules of thumb, like the 4% rule is the most popular one. I think they're fine for back of the napkin math, but the big downside there is like if you actually implement 4% as a withdrawal strategy, it's fixed over time. So it's not adjusting withdrawals up or down to prevent overspending or underspending. That's really why I like the guardrail strategy. But 4% is very conservative, almost too conservative in my opinion. So like there's a lot of studies out there that show if you retire on a 4% rule, you actually have equal likelihood of ending retirement with the same amount you started with or 6 times that amount. So that's obviously a lot of upside left on the table if you're using a rigid approach like that. So I already talked about guardrails, the dynamic strategy, quite a bit, and adjusting over time. So basically what we'll do is, set up the plan in the guardrails software, look at that strategy and say, hey, does this income that your resources can produce, does that meet or exceed your needs for retirement, what you envision spending? A lot of times it's more than what they would envision spending. So there's a lot of slack in the plan in some of those cases.
Yeah. Very good. How does, like, hypothetically, I just had this question the other day, if someone really wants to stick to the die with zero concept as much as possible and truly have the last check bounce and that be the check to the undertaker or whatever, how well does the guardrail approach do that, or how do you attempt to give people numbers with the die with zero thing, assuming they're only 60, you don't know when they're actually going to die?
Yeah, so it's tough if somebody really wanted to engineer the die with zero strategy, because again, the Monte Carlo is running in the background, and you don't want to force too low of a Monte Carlo score and kind of go the other way and run out before you run out of time, run out of money before you run out of time. But what I like about the guardrail strategy is it does get less toward, over time, you're less likely to underspend. So if your portfolio does really great over the next 10 years, hey, you're going to take income adjustments upward at that time, and it's going to still keep a reasonable buffer in there for, if the next 10 years of investment returns are horrible. So it's running that Monte Carlo analysis in the background. And of course, if you were to try to chip away at principal and, theoretically bounce the last check on the way out, you'd have to really make sure that long-term care was covered. I mean, I guess you could spend down all your assets and go on Medicaid, but that's probably not the ideal situation that folks would want to end up in.
Yeah, I think as much as the principle of die with zero sounds great, it's just like in reality, trying to implement it I don't say it doesn't work, but it's really difficult, dare I say impossible, to do with accuracy. I think in the book, like the extreme example he gave was, if you annuitize all your income, so you have like no liquid assets left, you just have these really big lifetime streams of guaranteed income, whether you live 5 years or 55 years, like that's what you're gonna get. You get to keep spending that every month, but there's nothing else backing that or behind that, which is also dangerous, because if a big expense or something out of the blue comes up, like you still need investable liquid assets, be it cash, be it invested, be it whatever, for that stuff. So I struggle with this. As much as I really love the principle, and I think a lot of my clients do as well, I have a hard time coming up with a way to okay, how do we actually get you to die with zero? You're only 60 now. I don't know. It's always going to be this moving target. You have to keep viewing and tweaking the Monte Carlos, the spendings, the asset levels, and keep trying to dial in and get closer and closer to that moving target as life progresses, they get older, and whether they die at 80 or die at 95 or 100, you have to kind of wait till that gets closer to really start to refine things, or at least that's my thoughts on the topic.
Yeah, absolutely. It's like you said, it's a moving target, and the best we can do is nudge toward that direction without actually trying to literally die with zero.
Yeah, and I think people need to commit. They have to be willing and able to be flexible with reining in withdrawals / expenses, right? Because the goal is you're going to spend more now than conservative models would generally say you could. But if there is a real nasty spell in the market, it's like a 5-year unprecedented string of down years in the stock market or something, you have to be able to cut back to ensure you don't run out and hit zero before dying. So there needs a lot of sort of buy-in and flexibility from the client as well to commit to actually trying to do a buy with zero thing.
Yeah, absolutely.
Okay. We already got ahead of myself with this, with folks that do have enough, trying to help them get comfortable with spending more. Interesting question. This came from a client of mine who thought this would be good to have on the podcast. What do you feel are your biases in what you do, how you do it, your views and opinions towards different topics, products, strategies, etc.?
Yeah. Everybody's got biases, so this was a really good one to think about. I'm a proponent of, like we already talked about, investment strategy, so broadly diversified, low-cost investing, and I recognize there's other approaches out there, and some of them do work from time to time, like momentum or trend following or private investments, things like that. There's a lot of different ways you can tackle investments, but I am biased towards simplicity being better than complexity, and I think that as planners, our time and attention is better focused on tax planning opportunities or the actual retirement plan than day trading and the portfolio itself. So that's the first one. I think the second one is, I think that tax rates in the future are probably going to go up versus going down. There's no math or calculation behind that, but the government, we've got a mountain of government debt, and I don't think it's going to fix itself. So that's just a hunch that I have. And then the last one I'll say is I think I'm biased to say that retirees can more often than not get more satisfaction out of spending on experiences or gifting with a warm hand than by leaving behind a huge pile of money at the end. So that's a bias. That's how I feel. I think a lot of my clients feel that way, but not everybody. So there are folks out there who, like, their goal is to live very frugally and leave that large legacy. But in my experience, that doesn't translate to the happiest retirement or making the most of their golden years.
Yeah, well said. And it's good. think this is a fantastic question. I'm glad the person brought it up. This really makes people reflect and think. And like you said, we all have biases, whether we know it or not. To really sit down and be honest with yourself, as much as your biased self will let you be honest with yourself about what your biases are. It's good to be cognizant of those.
Yeah.
Okay, in wrapping, I hate this question, but I love it at the same time. Anytime someone says, like, what's your one best thing or whatever, but I'm going to ask it. So if you can give only one piece of advice or word of wisdom to listeners about retirement planning, what would it be? And note, this is directed toward consumers, not other advisors.
Yeah, I love this question. And I would encourage those who are approaching retirement or actually in retirement to give as much attention to the non-financial aspects of this transition than as they do with, the actual dollars and cents. The jobs provide obviously a paycheck and cash flow, but they also provide structure, purpose, and social connections. So if you're not intentional about replacing those aspects in retirement, you can run into a whole host of trouble. So if you think about retiring, you've got 40 plus hours of structured work from your week that are basically blank on your calendar, and that's filling a void. So you need to be very intentional about filling that void. And the happiest retirees are the ones who I would say answer that question of purpose before they hand in their resignation. So I guess to summarize, my advice would be start building those intentional routines and activities before you retire. So what are the activities that would give your days meaning in retirement? Maybe it's teaching, maybe it's volunteering, maybe it's mentoring folks in your career field, and you can also test those ideas before you even retire. So maybe that's a long weekend, maybe that's a vacation. Kind of test out retirement and see what that activity looks like. So get the finances in order. That's obviously very important. You don't want to wing that, but also get your purpose in order and retire to something specific. And that'll ensure the most fulfilling retirement possible.
Here. The old, what is it? You have to make sure you're retiring to something as much as you're retiring away from something. Like, don't just retire because I hate my job, it's burning me out, I can't take it anymore.
Yeah. And
then you do stop, and now it's like, now what do I do? I've been doing this for 40 years. Your whole life can get sort of thrown upside down with this new normal, and that could be a real not pleasant culture shock and shock to the system if you didn't already have something to account for and a reason to now wake up, get dressed, and go do stuff, and whatever.
Yeah, it is a difficult transition. I've seen a lot of people have trouble with it, so the more you can get ahead of it, the better.
Yeah, 100%. Alrighty, and finally, where can people go to find out more about you and your business? Like I said, I will link to 7 Saturdays Financial. Anything else above and beyond you'd like to share?
Yeah, so like you mentioned, 7SaturdaysFinancial.com. You can learn about the firm and how we work, and we've also got a great newsletter that we publish twice a month. The sign up for that is at the bottom of our homepage, so you'll see that right there. And then the last thing is I'm pretty active on LinkedIn, so if you find me and follow me, you can stay up to date with the content and education that I publish there.
Awesome. I'll be sure to add your LinkedIn profile as well.
All right.
Well, cool. Allen, this was very fun, learned a lot, very informative. I'm sure everyone listening got a lot out of it, so thank you very much for coming on.
Yeah, thank you, and just a huge appreciation for the mentorship and the education that you put out, Andy. It's a great resource for the whole industry.
Oh, I'm happy to do it. Like I said, it's really makes me smile to see you come so far, do so well from where you were, I guess 5 years ago when this was all just an idea in your head. I love hearing and seeing success stories of people's dreams and visions actually manifest themselves as they wanted them and expected them to. Not just some random scattershot thing where now you got this business that's running uncontrollably, good or bad, and you regret it and whatever, but that is very much not the case with you. So awesome for you.
Yeah, thank you.
All right. Thank you very much, and take care, everyone.